All right, so today we're breaking down pension buybacks. What are they? How do they work? And when does it make sense to do one? Hopefully by the end of this video, you'll know whether a buyback could be one of the best investments you ever make, or you're better off keeping the money in your registered accounts or your other various accounts. So Shaun, I think an obvious first question is, what is a buyback?
Yeah, great question, Josh. So buybacks, first of all, apply to any of you who are participating in a defined benefit pension plan. So again, you probably know what that is, but it's usually called a formula plan. Formula might be, years of service times the benefit rate times the average of your best 5 years, let's say. So it's a defined benefit pension plan. And often buybacks are the ability to add to the years of service on your pension plan calculation to enhance your benefit. And the typical buyback opportunities are triggered by, it could be maternity leaves, it could be unpaid leave over the course of your employment. It could even be probationary periods at the early part of your career with the company. And really the big takeaway in the whole buyback discussion, not just what it is, but make sure you talk to your employer about whether you have past service through those kinds of areas that you can buy back. And it's actually important you take a look at it not just before you retire. It's a good question, right, to check off, but you need to actually ask it early on in your career, because what happens is the later you defer buying back, the higher the cost for you. So it's better to try to buy back some of that years of service early so that the cost is a little bit lower for you.
Yeah, that's really good. So often in these conversations, in these videos, the topics can get a little bit difficult because they're very abstract. So if you stick around, at the end, we're going to talk about an actual case study. I think we'll put everything together really nicely. But number two, if I have the opportunity to do a buyback, do a pension buyback, what's the best way, or how would I fund that buyback?
Well, I'll go over the two main options, and then I'll talk about in our experience what the most common option is for people. Okay, so you have the option to transfer money from an RSP account. So if you've got an RSP account with dollars in it, and you have the option to do a buyback. Let's say the buyback for you is $20,000. And you look at your RSP account and you've got, let's say, $100,000 in your RSP. Well, you could do a tax deferred transfer of that $20,000 from your RSP account to the pension plan to fund the buyback. So that's one option. The other option, if you don't have RSP assets or registered assets, you can do a cash contribution to the plan. And as an example, like, it can get a little bit complicated, but for years of service after 1989, you can make a cash contribution. It's fully tax deductible in the year that you make that contribution to the pension plan for the buyback. But what we see for the vast majority of people is they look at the buyback, they have RSP money, and they just do a tax deferred transfer to the pension plan for that buyback. That's by far and away the most common experience we have.
Yeah. What is, when you're considering a buyback, I know there's a bunch of different factors like retirement age, how long you think your life expectancy is going to be, your income and all that. What are some of the main factors that someone should consider when considering a pension buyback?
Yeah, again, another great question. There are a lot of factors. And of course, whenever we talk about these topics in the retirement planning context, it's always with the provision that, do you have a plan? So you should always be making these decisions in the context of your plan. So we're talking about a specific issue, that's buyback, but it's best to look at it in the context of your planning. And by the way, in the show notes, there's a link back to free resources in retirement planning. And if you're confronted with this decision, you'll want clarity, there's a link back to our website where you can set up a complimentary meeting to find out how we can provide clarity for you. But if I looked at some of the key factors, one is retirement age and plan rules. And are there penalties or factor thresholds? And actually in our case study, we'll talk about that. But an example is a lot of pension plans will have a magic 85 or a magic 80 or a magic 90. And what that refers to is when you take a look at the combined age of the individual and their pensionable service, years of service, as long as they add up to, let's say, 80, then there's not an actuarial discount or reduction on their pension plan. So these buybacks can be very important because you might have somebody who's just on the cusp of, let's say, their magic 80 or magic 85, and they're 2 years short, and then they find out they've got 2 years worth of buyback they can make. And it may look relatively expensive at that point because you're just near retirement. So remember what I said, it gets more expensive the longer you defer this decision, but it could lead to very meaningful enhancements to your pension benefit if you buy back that, let's say, 2 years that is available to you so you don't get hit with a penalty. Some other factors, again, this gets back to planning, is life expectancy. So for some people, they may do a buyback if they're really concerned about longevity risk. Other people would maybe not do the buyback because they're more concerned about having liquidity, right? So you've got RSP capital with its lots of flexibility in terms of how you use it in the early phase of your retirement. It might be for traveling or enhanced lifestyle during that go-go phase. If you end up transferring that capital, some of it to your pension plan for a buyback, now you've converted money from a lump sum that's very flexible to a monthly income payment that dies when you or your partner die. So you have to think through what kinds of flexibility do you want in your cash flow planning. We talk about ways of looking at enhancing buybacks. Those are sort of the two of the main things. Funding sources, again, we talked about almost always doing a direct transfer from your RSPs. If you have RSPs, is probably the best way of facilitating that.
So one of the things that you mentioned was longevity risk. And I think if people watching this, they don't really know what that is. It's the risk of outliving your capital, right? You get to age 90 and all of a sudden you're running out of money, but you're still alive and you're still doing things. So one of the most interesting calculations you can do when comparing, do I buy back my pension years or do I not, is what is my break-even point, right? So how many years do I need to live into retirement for a buyback to be more beneficial than keeping that money in my RSP or something? And I think, like we said, if you want to figure that out, make sure you go to our website or the description below and talk to us. We do this all the time. So moving on, there are a bunch of other considerations that you wanted to talk about, I think, that provide more kind of clarity around the decision.
Yeah. So another really important factor is your current pension plan have a COLA, cost of living adjustment, attached to it? And what we find is that is probably one of the biggest drivers of this decision. In general, if I can buy back past service on a defined benefit pension plan that is a cost of living indexing provision, it's very, very rare that we're going to see a situation where it does not make sense for the client to do the buyback. So if you take a buyback amount, you get enhanced pension. That pension then from retirement to life expectancy is indexed at 2 or 3% per year. That's one of the best investments you can make. So in almost every situation, you want to seize that opportunity. The problem is there's not a lot of defined benefit COLA adjusted pension plans that are contractually adjusted to inflation every year. That's becoming rare and rare. So when we look at non-cost of living adjusted pensions, there it's a little more dubious. So I talked about this magic 80 or 85 or 90, depending on the pension plan. That's a really critical hurdle to get over so you don't get big reductions actuarially on your pension plan. But past that point, if your pension is not indexed and you're throwing money from your RSP account into the pension to do the buyback, again, like you just said, you might do that because you're trying to have a baseline income that you never will outlive, but you're losing flexibility. So often we'll see clients not initiate buyback if they've got their magic 80, 85, because they want to keep money in their portfolio for additional flexibility. So, that's an important consideration. The other is around estate planning. So the minute you get into this whole pension decision, we do have clients that go, I want lifetime income. I want my non-discretionary expenses covered off. I get why that's important. So my defined benefit pension plan, my CPP, and my OES gives me that base of that retirement income pyramid. But I want to make sure that I'm keeping some money liquid, either for additional lifestyle during the go-go years. We've talked about that. And for some clients, it's around estate planning. They don't like defined benefit pension plans because there's usually no residual value to the estate in a last to die scenario. So if I've got a pension plan that's defined benefit, I'm required to put a survivorship benefit on that plan for my partner. And when my partner dies, usually there's little or no residual benefit for the estate or for the kid. So sometimes clients will make these decisions in the context of not just income, but estate planning. And then the last point I'd make around other considerations is this notion of don't put everything in one bucket or one particular strategy. And again, it gets back to liquidity. And sometimes clients will be reluctant to put money into a pension plan for buyback because they're a little bit concerned about the solvency of the pension plan. And that can be a somewhat legitimate concern. We all have heard stories of pension plans that have been underfunded, and the regulators have not been on top of the employer to keep that funding in place. And then the pension plan becomes at risk because the company goes bankrupt. And now, pension superintendents provincially and the regulators are chasing companies that don't even exist anymore for money to deal with the underfunding of the pension plan. So if you've got a pension plan that's fully funded, it's in good health, great. But before you do a buyback, that is a question you need to ask. How healthy is the pension plan that I'm involved in?
Yeah, that's a really great point. All right. So as we mentioned before, we're going to do a case study to kind of put a story behind all these abstract words that we're using here. So do you want to lead the charge on this case study?
Yeah. So Sarah approached us. She had a buyback opportunity. She's 45, she's a teacher, and she currently has 12 years of pensionable service. And her goal is to retire when she's 60. She's currently making a salary of $80,000 per year. Now, if you look at her current trajectory in terms of her years of service, she's in a plan provincially where it's a magic 90. So without the buyback, and she does have some years of service that she can buy back, she's going to have 27 years of service at age 60. So she's short of that magic 90. And the result for Sarah was she was going to be hit with an actuarial penalty of 25%. So her normal pension without penalty would be $48,000 per year. With the penalty, it'd be $36,000 per year. So a pretty significant hit. And so she obviously was motivated to see whether she can get around that. She didn't really want to work longer to get those extra 3 years. And so we found out that she did have those 3 years of buyback. Now, the bad news was the cost for that buyback was $60,000 to get her those extra, 3 years. So we said to her, listen, if you take $60,000 out of your RRSP account, transfer it to the pension plan, buy back those 3 years, you're going to go from $36,000 per year to $52,800 per year. And so you're qualifying for the magic 90. You're not going to be subject to a penalty. So that's a pretty huge enhancement. That's $16,800 per year, every year for the rest of her life. Over that time period, that's well in excess of $400,000 of additional cash flow. So the break-even point, I think, on that investment was 4 years or something like that. So it's in that situation, it's a slam dunk. She had the money in her portfolio. Yes, that $60,000 now is not going to be there to pay for some of the traveling she wants to do, but she's going to enhance payment from the pension plan, so that can be used then to pay for some of those additional expenses. So that's a classic situation we see all the time. And the other situation we see as well is the buyback where there's cost of living adjustments. And again, more often than not, it makes sense. In this situation, Sarah's pension plan did not have contractual cost of living. It was basically ad hoc if the pension plan did well. But because she was subject to penalty, it certainly made sense for her to go ahead with this strategy.
The big thing there, do I buy back? Do I not buy back? And I think that break-even calculation is, in my opinion, the most interesting part. It's like, how many years do I need to live into retirement for that buyback to be more beneficial than not?
Yeah.
Awesome. All right. So I think something that would be really useful at the end of this video is to do a quick fire Q&A session with the expert, Shaun. So I pulled together some of the most common questions we get about pension buybacks. I mean, these questions are not that complicated. They're pretty simple, but they're really legitimate questions that people often have. So question number one, is a pension buyback always worth it? You kind of answered this before, but maybe summarize.
Not always worth it, but if it avoids actuarial penalties and it boosts your pensionable income to take advantage of higher salary ranges and there's cost of living, absolutely can often make sense.
Awesome. All right. Does a pension buyback affect my RRSP room if I fund it with my RRSP?
Great question. And this is often something that gets people in trouble. Okay, so I do the buyback and now I've enhanced my pension. And what it does is it triggers a past service pension adjustment, a PSPA, and that reduces your RRSP contribution room. So you might get into some issues where you might have to make adjustments to RSPs. There might be an overcontribution situation to be aware of. So what you want to do when you do the buyback, you want to meet with your financial advisor, have them do a calculation as to what the impact might be on your room. Because once you put that money into the pension plan, it can trigger this past service pension adjustment.
But just to be clear, if I use my RSP to fund this pension buyback, I'm not going to have to pay tax on that money.
Right. Yeah.
Perfect. So this next question, do pensions leave anything for my family if I pass away? We just did a video actually on, was it defined benefit pension plans at retirement or RSPs at retirement, I believe. And we dive into the survivor benefit question. Make sure you check out that video. But do pensions leave anything for my family when I pass away?
Yeah. So again, your spouse will have survivorship benefits likely on the pension plan. So they'll get benefits. Like I said, you and your spouse is passing away. There's usually very little residual benefit. There is something called a guarantee period on pension plans. The way the guarantee period works is that me and my partner can get a pension plan. Let's say it's a 2/3 survivorship to my partner on my passing. And then we could also attach, let's say, a 15-year guarantee period. And what that means is I pass away, let's say in the first couple of years of retirement. My partner then doesn't live to average life expectancy. Let's say pass away 5 years later. And we have basically, we're into now that 15-year guarantee period. There's 10 years left on that guarantee period. We're 5 years into it. Then the pension plan will make a lump sum payment equal to 10 years worth of pension payments to the estate or beneficiaries. Again, what's the chance that you and your partner are not going to live, at least one of you are not going to live to average life expectancy? That's probably a pretty small chance. Not a super big fan of guarantee periods on pension plans. I personally think it's a bit of a waste of money. It may make sense for a single individual that's annuitizing. I don't think it makes sense for a couple who are in reasonable health to do it. There's other ways of passing on estate value, whether it's having some permanent life insurance in place or just managing your portfolio so you're not spending it all and having residue that you can gift to your family or charities.
All right, so that's pretty much all the questions that I've pulled together here. I know if you're watching, maybe you have some more questions. Make sure to comment them down below. We'll try to answer them. We'll try to get in the comments and answer any others that pop up. So obviously buybacks, they can be a fantastic way of funding your retirement if the math works out. But a lot of times the math doesn't work out, especially if your pension is not indexed to inflation. So that's all we got for this video. Shaun, thanks for all your thoughts and your advice. Thanks for watching.
Yep.
Take care.
Thanks, Josh.